Hello, and welcome to Keypoint Accountants and Advisors. I'm Chris Dobby, and today we're going to talk about pre-30 June tax planning. Today we're going to talk about in the agenda. We're going to talk about what the key benefits are of tax planning and what the risks are of not taking it. Two, what the three key steps in those strategies are in relation to tax planning and getting the best outcome for you guys in relation to your goals and objectives. What are the tax rates, understanding what your tax rates are, where do you sit and what are your positions. 4, we'll go into your individual tax planning, what individual strategies you can put in place to help minimise your tax. 5, we'll look in the business tax planning, a lot more specific, a lot more opportunities and a lot more goals and objectives that we need to discuss and identify. Then we'll go into what key takeaways you'll take from today so that you can go on action and implement straight away today before 30 June. And if you want to take any extra steps, I'll let you know on how to do that at the end. So thank you for listening and I hope you enjoy it. Benefits and the risks. Firstly, the benefits. The key benefit that we identify is 1, you get the clear understanding of exactly what your current tax position is. You know what your liabilities are, if there are any, and you know what your cash commitments are. Once you can identify that, then you can maximise any deductions that you want. You will be able to minimise your tax, if that's the ideal goal and objective, and make informed decisions about whatever goals and objectives that you have personally or in your business, which is critical when it comes to tax planning. Tax planning is not just about minimising tax. Obviously, on the way through on that, we're always very mindful of cash flow. So it's all well and good to get tax deductions, but you still need to fund that. So what is the true benefit and can we fund it and how is that cash flow going to service that? And then obviously if there's any other major one-off transactions or capital gains events that have happened throughout the year, that maybe you could look at those specific strategies and identify things that affect that one. The risks of not doing tax planning are quite obvious. You have no understanding of what your current position is. You run blind, and then when the tax position comes around in May next year, you go, oh shivers, why did I get to that tax position when you could have had strategies implemented now to minimise that position with obviously potentially increased tax liabilities, penalties and interest. That can be a position when it comes to director loan accounts in businesses, so making sure that we're adhering to those things. And obviously if you don't have the cash to pay any tax liabilities, there'll be interest as well on those things. And the other big concern is not knowing now where your current cash position is and spending money that's not yours, it's really the taxman's, if that is the case. So they're pretty significant impacts. When we're first talking about, so the three key steps in relation to tax planning, step 1 is obviously finding what your current tax position is. Where do you sit year to date, whether it's an individual or business? What's your year to date tax position, whether it's a group certificate year to date or a business? What's your profit year to date? How much tax have you paid year to date? Where do you currently sit? Then we can identify where your forecasts are. Let's forecast that out to 30 June in the next 2 to 3 months. What is that position going to be come 30 June? Where are you going to sit? Because then you can have a clear understanding of exactly where you're at. So then you can go and move on to step 2. What are your goals and what are your business objectives? It may be to minimise tax, it may be to reduce your income, but it may not. It could also be, I need to show solid income because I'm looking to buy an investment property next financial year, so I need to be able to service on that. So understanding what your position is, whether you're selling assets or buying assets in the future, now and in the future, we need to understand that. So then you can move into step 3, going, what strategies can you implement today to help you achieve those goals and objectives that you've identified? Personal goals. I'm just going to go straight into this because I find this is probably the most critical and important position for anybody before they actually start thinking about tax planning. Do I want to increase my income or do I want to decrease my income? obviously most people think tax planning is to decrease their income, but it depends on what their, as I said earlier, what their current and future goals are. And that could be, we're going to look to be buying and upgrading our home, or we're looking to buy an investment property, or looking to buy more shares. You may be looking to sell some assets. Do we do that before 30 June or do we do that after 30 June? What is the tax consequences of deferring that? Is it a better tax position next year? We're looking to retire. Should we be selling down some investments now to create some liquidity so you can retire? Is there money in super? Should we be dumping money in a super? Are we selling a business? So there's many strategies that we need to understand, and objectives of yours that we need to understand first before you can choose that. Another big one is financing. So it's all well and good reducing your taxable incomes and reducing the tax, but what we identify sometimes is people do that without understanding the consequences, that in 6 to 12 months time when you want to buy a new property or investment, you can't service it because your taxable incomes from the year before are so low because you've minimised things. So we need to understand what you're looking at and considering into the future. And there may be other circumstances and goals that you may have that you want to achieve as well. In relation to business, it's very similar. Obviously, it's about income and profit. Where we sit, what do we want to achieve, and what reasons do we want to show the profit or not. You may be refinancing a business loan that you need to show good numbers for the finance facilities. You need to understand what your cash flow commitments are. You may be buying new assets and new equipment. Maybe I need to spend $300,000 on a piece of equipment. Do I need to do that before 30 June? Post 30 June? Do I finance that or not? All these are considerations when it comes down to pre-30 June tax planning. And also, are we looking to extract extra income out of the business? How do we do that? Because if we do, it's going to increase your personal income and we need to manage that for tax planning. And again, financing and servicing, where we're looking to buy a commercial property in the business or buy a large piece of equipment. Do we finance it or not? Can we finance it or not based on our incomes and our servicing of those financials that we've just talked about? And the other one is exit strategies. So if you're looking to exit the business, sell it down or sell to a third party, you might look to be minimising your tax in the past years, but now might be, well, we need to show the profit for the future buyers. So understanding again what those goals are moving forward will dictate and determine which strategies you implement. Tax rates. When we're talking tax rates, I'll be quick on this slide. It really is what we're focusing on. Company tax rates are at 25% for a trading entity. If it's a passive company, it's 30%. And as individuals, Australian residents, these are the tax rates. It's important when you're discussing or identifying these positions, whether or not if you're a husband and wife, or your income's over the 120 thresholds, one person's under, one person's over. How do we manage that income space? Or if you're over 180s, how do we bring you back to 180 if you're just over the 180 threshold, so you're not paying 47 cents on the dollar? There's and when you get higher incomes, there's even more so. And also with partners that are not working, that tax-free threshold of 18,200 is significant, especially if the other partner is a high income earner. So they're all areas that we need to identify on the way through. So let's talk about individual tax planning. I'm just going to bring all these up because I think we're going to get through these pretty quickly. Okay. Number one, one of the most main deductible expenses that you can claim is motor vehicle, home office, work-related expenses, if you're able to in relation to your occupation. What I always say to everybody is, if you're doing something for work that is costing you money, it is highly likely that it's a deductible expense. And you should be making a note of it and bringing it forward to your accountant at tax time to then identify whether or not it's a deductible or not. Understanding what those home office expenses are, whether it's you're going to do actual cost method or just do 67 cents per hour. You're doing 5 to 10 hours work from home. If you're working 2 days at home and 3 days at work, there's different scenarios for that. So make sure you keep your diary records. The work-related expenses, you can jump on the ATO fact sheets, which are there. So if you've got a specific occupation, there's specific strategies that you can see straight off the HO tax portal, which will get you there real quickly. Net investment losses and gains. So if you've made or sold a investment property, or you've sold some crypto, or you've sold some shares, what's the tax consequence on that for you as an individual? And then maybe bringing forward some capital losses or considering capital losses to offset that on the way through. Income protection, if you've got it, obviously it's a deductible expense. Donations is another one. Are you considering donations before 30 June? Personal super contributions have become an attractive position. I'm going to talk about that more on the next couple of slides. But the government has opened significant opportunity over the last few years to be able to bring forward prior year deductible contributions that you have not yet made and get deductions for it. High income earners, other things that you need to consider, and these are people over the 180,000 tax bracket. Once you get over $250,000, you need to pay an additional tax on your super contributions going into super. Most people are not aware of this. So red flag, if your personal income is more than approximately about $220,000, $225,000 plus super contributions, you should be considering what deductions you can get so that your combined income brings below $250,000, because it actually saves you 15% on the super contributions that you or your employer have made going into super. You should talk to your accountant if you're close to those numbers. Medicare levy surcharges and private health. If you're a sole trader or you're an individual person, your income's more than $90,000, you're going to be paying Medicare levy surcharge. And if you're over 180 as a combined couple, it's highly likely you'll be paying Medicare levy surcharge if you do not have private health that covers hospital. So be cautious. One, make sure if you do have private health, make sure that you do have the right cover to avoid the Medicare levy surcharge. And two, if you're over 30 and you don't have private health and now you're considering, because your incomes are now higher, there's penalties from the private health companies. So you need to understand what those risks are. So if you don't have private health and you think you should, again, talk to your accountant. What's the pros and cons in that space? Because it's likely that you've got more pros to maybe save some tax on the way through. Superannuation, I'm not going to go into all of them, but the big one is at the moment is the 5-year carry forward concessional contributions. What that means is that if you last year only contributed, say, $15,000 into super and the contribution limit was $25,000, you can put in an extra $10,000 into super as an employee, as a personal contribution, and it'll be a tax deduction. And depending on what your tax threshold you're on, whether it's 32.5% or the 39% or the 47%, then you'll actually save a significant amount of money when it goes into super. You lose some when it goes into super, but it's a significant saving and benefit day one by contributing into super. That also then determines what age you're at. If you're young, do I want to do that now or not? Or if I'm 45, maybe a different category. Or if I'm 55 and I'm getting closer to retirement, I'm more likely to. So it comes down to age, personal circumstance, cash flow, personal goals and objectives. But that carry forward super contribution is significantly a great opportunity for individuals to put money into super and get large tax deductions immediately. Investment property owners. A couple of key things here. What I'd suggest is step one, if you're considering doing repairs on your investment properties or replacements to kitchens, you need to be cautious. People get mixed up in what is a immediate tax deduction versus what would get depreciated over a period of time, whether it be 5, 10 or 15 years. So if you're considering spending significant amount of money, talk to your accountant, ask them, is this a repair or is this a replacement? Because if you're spending 20 grand, for example, on a fence that is replacing an old fence, you're not going to get a $20,000 tax deduction in your personal returns. It will be deemed an improvement and it'll get depreciated over a period of time. So you only get a small amount. And if you're doing it right now, you're only going to get 2 months of this 12-month financial year. So just caution when you're looking at those positions. Number two is where you could consider paying some interest up front. Obviously, probably not likely given the recent rate rises over the last 10, 11 months. So most investment property owners would have a larger amount of interest to be deductible, but hopefully their rents have also gone up to offset that. So that'll probably have an impact. And those people that have got homes probably less than 20 to 30 years old that are not claiming depreciation on their building, you should consider reviewing that with your accountant again, getting a quantity surveyor's report and be able to claim the depreciation on that building, which is not creating a cash restriction for yourselves, but it's actually creating a great tax deduction in relation to that investment property moving forward. And the other one is if you're considering selling your property, do you sell it before 30 June or do you sell it post 30 June? Because it all bases, the capital gain is calculated on the contract date, not the settlement date. So if you get a contract signed next week in relation to the sale of your investment property, it'll be deemed a capital gain in this financial year, and the tax liable on that gain will be fall likely in May 2024. If you deferred that and got a capital gain and you contracted in, say, July, in 3 months' time, that tax liability would fall due in May 2025, and you just picked up an extra 12 months of those funds in your pocket initially. Again, it's just a deferral. Business tax planning. Okay, so when it comes to businesses, so again, we've got to remember back, what are the goals and objectives of you, the client, in relation to that business? Is it to reduce profit, increase profits? We've got to look at those. But let's assume the goal is to reduce the profit. So obviously we look at prepaying expenses. What expenses can we bring forward that are within 12 months that we can pay up front? Again, it's a cash flow position. We've got to understand that cash flow. Step two, is there any income that we can defer into the next financial year? And you've got to be mindful, because when you're doing prepayments or you're deferring income, all it's doing is just shuffling the income and the expenses from one year to the other. So it's just better managing the timing of when the tax liability is due. Or if it's newer expenses, then obviously it's a straight deduction. Employee contributions. A lot of people pay their super for the employees quarterly, and it's a recommendation that you maybe pay April and May's, get them paid. Super is only deductible, one, if it's paid on time by the 28th after the end of the quarter, 28th day after the end of the quarter, or if you, for July, April and May, you could pay that today. You can get those deductions this side of the financial year, and June's you pay on the 28th of July, before the 28th of July. And that's the only month deductible next financial year. Division 7A, or director loan accounts in companies. So when you're doing planning, we've always got to look at what's happening with this loan account, if there is one. So if you're being lending money from or taking money from your company that's not a wage and not a dividend, then the company has been lending you that money. And that's what creates what's called a Division 7A loan account, and you need to either, one, repay that back, or two, we need to pay that out as a dividend. So understanding that position, we need to look at what those dividends are, or what those loans are, to work out what tax consequences that could create for you guys as individuals, to then determine in your individual returns what tax deductions do we need to help minimise that tax liability. It's really, really, really important, that one. Stock takes and work in progress. So obviously just looking at your stock take and work in progress, because they can have an impact on your taxable incomes. And in relation to those, if you're in retail, you could consider, or hospital or wholesale, you could look at your stock and look at any obsolete. How do I clear that out before 30 June? Fire sale, reduced sale, pre-30 June sales, and write off any other stock that's not sellable anymore. It'll actually help reduce your profit. Some other items. So in instant asset write-off, which has been around for a few years now, which has allowed many people and many businesses have over the years, post-COVID, with all the JobKeeper and cash flow boosts and the income that's fed in, people have bought many assets for their businesses, which is excellent. but everyone's claimed the immediate deductions on those assets. So now they've been written down to zero. This is the last year that you can grab that opportunity, which is coming due 30 June 2023. There is whispers that may be extended, but there's no guarantee. So at this stage, that's our end date. We'll know more after the federal budget in May. And the other one is if you're selling any of those assets, whether it be a car in the business, as an example, if that's been completely written off 3 years ago, and now we're selling it for 30 grand, we're going to have a straight profit on the books, and that's going to increase that profit. We're going to have to pay more tax, so we need to understand the consequence of that too. So whether you're buying or selling any of those immediately written off assets, it's important to understand what that is going to do to your personal positions, because it's going to affect your cash flow. Dividend payments. If you've got dividend payments in your company feeding through, we also got to understand when that feeds through into your personal hands, what is your personal tax bracket? So in most circumstances, your companies are taxed at 25%. But if you're at $180,000, your taxable income is now creeping over 47% on the dollar. What that means is when that dividend comes through into your hands, you need to pay top-up tax from 25% up to 47%. So when the money comes out, you need to be quarantining the cash on that. Or we look at your personal circumstances and we try and minimise that tax exposure. But you need to understand that that's where people get caught out a lot. Income splitting, it's just making sure you and husband and wife are in the similar tax brackets. So it's a mutual position. Small business entity rules for CGT concessions. So if you are selling or have sold a business, probably more so a business, are you meeting small business entity rules? If you're considering selling a business in the next year or two, this is also critically important because there's significant CGT concessions when you sell your business if you meet those rules. So if you're considering those space, reach out to your accountants and talk to them 1 to 2 years out, pre-planning to understand what that looks like for you, especially if you're close to $6 million in personal net wealth, you're getting close to rules. Trust distributions. Over the last 6 to 7 months, there's been significant ATO changes in relation to trust distributions, and it is a highly cautioned, highly ATO targeted area. It is absolutely critical. Now, everyone has to do their trust minutes before 30 June, but in relation to that, as a general guide, if you're paying a distribution to somebody through your trust, they need to physically receive the funds. And excuse me, and keep those funds. They can't then pass them back to you. You need to talk to your accountant in relation to those. It's a critical and a highly targeted area by the ATO. Bucket companies. You are allowed to distribute to a bucket company. Now, in relation to that bucket company, it should be trading in its own right. Like set up that asset holding entity and let it go and do its own investing. But if that company's just there to quarantine and then pass the money out to you in the immediate future, it's probably not an ideal scenario. Okay. Abnormal one-off significant events. Capital gains and losses during the year. So just quickly, so if you've sold your business, you've sold a property, you've sold some long-term shares, you've made some crypto gains. Let's just say in relation to property sales, share sales and crypto sales, the ATO are aware of it. They know that you've been doing transactions, and as your accountants, we need to bring that to account. And it's important probably now, especially when you're doing those transactions, to reach out to your accountant and know what your positions are. You don't want to get all that cash, spend it on something else and then go, oh, I didn't make a gain, but you really did. So you need to understand those positions so we can then do some planning and some deductibilities around that to try and minimise those tax exposures. And I've already spoken about the sale of business assets that have previously been written off. I think there's a big exposure there for businesses into the future, and I'm trying to bring it to light so that everyone's aware of those positions. All right. I've punched through that pretty quickly. There's a lot of information in there, but a couple of key takeaways that I want you to be able to take away. The first one is obviously one, the best time to do it is right now. You've got just over 2 months. You've just got a few months to pre-30 June, and it's going to be the same next year and the year after, to actually identify where you currently sit, where you think you'll sit by 30 June, and what opportunities you can take now to achieve whatever your goals and objectives you got. And again, remember, it's not necessary to minimise tax. You might be trying to increase your incomes for a better sale value. You may be looking to increase your personal incomes to be able to service a future asset purchase like a new home for finance. They're critical things that you need to understand before you just chase a tax deduction. And the other point on that is with the tax deduction, if you spend $10,000 or $100,000 to get a tax deduction, you're not saving $100,000 in tax. If you're getting a $100,000 tax deduction, depending on what your tax rate is, that will be the cash saving. So you're still out of pocket. For example, if it's in a company, you'll save $25,000 on that 100. You're still out of pocket $75,000. So, or if you're an individual, you spend $10,000 and you're on a 47% tax bracket. You save $4,700, but you're out of pocket still $5,300. So make sure they're good, wise investments when you're minimising your tax. Obviously, that gets you that clear understanding, and obviously we work with you in relation to your cash flow requirements and cash commitments as they stand. The next one is to identify, obviously, then you go through, you guys identify those tax deductions, minimise your tax if that's the goal and the strategy that you're after. But make sure, and obviously we make sure that it's inside the HA rules and guidelines. And the big one for me, another one is looking at those complex one-off transactions. Don't just think that you know what the number is. Get your advice, get the guidance, and know how much you need to quarantine, okay? So next steps are on our website. You can jump on and have a look at our newsletter that's got those summaries, or alternatively, you can engage Keypoint. We can do more formalised strategy plannings in relation to it, which we will work with you to identify exactly what your positions are, and we'll focus on what we're going to do to meet your specific focused goals and objectives to suit your needs, both now and in the future. Okay, so from here, if you like, thank you for listening. And if you want to connect with us, please reach out to Kelsey at the office on 55850 if you want to book an appointment and have a pre-30 June tax planning. And if you want to know more information, click on the link below and that'll take you straight through to what your options are in relation to Keypoint. If you have any questions, again, please feel free, reach out, check our website, there's checklists and prompters on there, or call the office on 55850 600. Thank you and have a great day.